45 years ago, a group of office workers gathered around a desk, staring at a machine that could barely add and subtract. It was IBM's first personal computer, and no one in that room could have possibly imagined its future impact. That moment, when a new technology shifts from being theoretical to becoming profoundly visceral, is exceptionally rare in the world of investing. According to ARK Invest CEO Cathie Wood, it just happened again, not in a lab or a keynote speech, but in an accounting department. Welcome to Crypto Signal, where we uncover the forces shaping the future of finance. Today, we're diving deep into why the two most significant signals in this market, one from technological innovation and another from monetary history, are converging, and why most people will likely miss their chance to act until it's too late. Stick around, because we're about to reveal a critical insight that could redefine your investment strategy. Cathie Wood, who leads ARK Invest, one of the world's foremost innovation-focused investment firms, has a remarkable track record for identifying technological inflection points, often being painfully early on breakthroughs from Tesla to genomics to Bitcoin. At a recent ARK offsite in St. Petersburg, Florida, she shared an anecdote that brought her team to a halt. A member of their finance team was utterly astonished by how rapidly he could automate 6 months' worth of planned automation projects using an AI tool like Claude. While ARK integrates with Palantir, this individual accomplished the tasks independently. The team was shocked by the sheer beauty and precision of the generated graphics and tables. Even after cross-checking the numbers with manual additions, subtractions, and percentages, everything was perfectly correct. Cathie described this as another PC-like moment, echoing the revolutionary introduction of the personal computer 4 to 5 decades ago. She emphasized that disruptive innovation has been slowly germinating for many years, with seeds planted in the 2 decades spanning from the PC's advent to the dot-com bubble and bust. These technologies weren't ready to flourish then. We saw the emergence of cloud computing in 2006, followed by the first major AI breakthrough in decades with deep learning and ImageNet. An even more provocative breakthrough arrived with transformer architecture in 2017. Now, this slowly phase is rapidly transforming into all at once, not merely because the technologies are mature, but because they are powerfully converging. It's truly an exciting time. This story is more significant than any chart or data point we could present, as it perfectly encapsulates the moment a technology transcends from merely interesting to absolutely indispensable. A finance professional, not an engineer or developer, leveraged an AI tool to automate half a year's work. The visuals were stunning, the tables flawless, and the figures aligned perfectly with manual calculations. The observers were genuinely amazed. Cathie drew a parallel to 1980 when Apple released the Lisa and IBM launched its first PC. Back then, these machines could only perform basic arithmetic. Look how far we've come. Her central point is that we are now at a similar technological threshold, yet many people fail to see it because this profound transformation is occurring within companies, not just on stock tickers. These productivity gains are tangible, accelerating, and largely invisible to anyone not directly utilizing these new tools. Now, here's why this is especially critical for Bitcoin investors. If AI is genuinely igniting a productivity revolution and mounting data increasingly supports this, then the economic landscape is shifting fundamentally in ways that traditional models cannot capture. For instance, U.S. productivity grew by roughly 2.7% last year, nearly doubling the average of the preceding decade. The Bureau of Labor Statistics later revised payrolls down by over 800,000 jobs, yet GDP remained unrevised. This divergence between declining employment and stable output is the mathematical hallmark of productivity growth. Companies are producing more with fewer people, and this is only the beginning. However, there's a significant caveat. Productivity revolutions rarely feel good while they are happening. They breed confusion, jobs vanish, earnings become erratic, and markets grow volatile. Investors, being human, react to this uncertainty as they always have. They panic, they sell, and they convince themselves that their investment thesis is fundamentally broken. Larry Lepard has witnessed this very pattern decimate investor returns for decades. A veteran gold and Bitcoin investor and author of The Big Print, Larry has navigated enough market cycles to understand that the greatest adversary in investing isn't the market itself, but one's own psychology. He has a crucial story that every investor needs to hear right now. Larry recounts how many newer investors, observing recent price action, approach him, questioning if their thesis is broken or if they've made a mistake. Even seasoned individuals, like his wife, express similar anxieties. Larry, having been involved since 2013 or 2014 and having witnessed Bitcoin's journey from $17 to $9, then $3 or $4, and later from $65,000 to $15,000, remains remarkably sanguine about the price. He echoes Michael Saylor's sentiment: Bitcoin is digital capital, a highly volatile asset requiring a 10-year time horizon. He consistently advises prospective investors, regardless of their entry amount, to be prepared to endure a 50% drawdown, or even slightly more. Historically, Bitcoin has seen drawdowns of 60%, 70%, 80%, and even 90%. While the current drawdown is around 50% from its October high, Larry believes it could potentially reach 60%, though he doubts it will hit 70%, a point we'll discuss shortly. To Larry, this is simply classic fear and greed, investor behavior as old as time. It's akin to Warren Buffett's Mr. Market, a manic-depressive character. At $125,000, people chase Bitcoin, convinced it's heading to $250,000. Yet at $67,000, nobody wants it, fearing it's going to zero. Larry refers to a study from the 1970s and 80s about Peter Lynch, who managed the Fidelity Magellan Fund from 1977 to 1990. Lynch achieved an astounding 29% compound annual rate of return, a track record comparable to Buffett's. It was a truly exceptional fund, making fortunes for those who invested early and held on. However, Fidelity's subsequent study of its customers who held the Magellan Fund revealed a shocking truth. 50% of these investors made no money at all. The average return for the typical Magellan Fund investor was a mere 7%. How could this be? Those who earned nothing chased the fund when it was performing well, exclaiming, "This is great, I have to buy it." They bought at the highs. Then, when it dipped, they panicked, thinking, "Oh my God, I made a mistake, I have to sell it." On average, most people followed some version of this behavior. Had they simply bought at the beginning and held until the end, their compounded annual return would have been 29%. Instead, the average customer return over all those years was 7%. This illustrates a profound point. Human nature almost inherently wires us to make investment mistakes, compelling us to chase price and abandon deep value. Let that resonate for a moment. Peter Lynch delivered 29% annual returns for over a decade, one of the greatest track records in investing history. Yet, half the people who held his fund made absolutely nothing. Zero. The average investor earned 7% in a fund that compounded at 29%. This happened because they consistently chased the price on the way up and sold on the way down. Bitcoin tells the same story, but on a grander scale. It has outperformed every other investment over the past 15 years, yet the vast majority of its owners have either sold too early, bought too late, or panicked during drawdowns precisely like the current one. Currently, Bitcoin is trading at levels that various valuation models, including the Power Law and the 200-day moving average comparison, flag as historically cheap. It has been more expensive than this 90% of the time. However, the Fear and Greed Index sits at 12, indicating almost nobody wants it. This is the Magellan Fund problem playing out in real time. The asset works, but the humans holding it often do not. If this story were solely about investor psychology, we could conclude here: endure the pain, don't be the Magellan Fund investor, and zoom out. However, Cathie Wood introduces another crucial dimension that many in the crypto space are overlooking. Her productivity narrative doesn't just explain why markets feel confusing, it illuminates where the economy is truly headed and why the inflation landscape is on the cusp of a dramatic shift. This is a critical insight. The Bureau of Labor Statistics revised household employment figures down by 1.4 million jobs for last year, an enormous revision. Yet GDP remained steady. The only way these two numbers reconcile is if productivity surged far beyond anyone's measurements. Cathie Wood is not alone in this view. Eric Brynjolfsson at Stanford has published research illustrating this exact pattern, the J-curve of AI productivity, where initial investment suppresses measured output before a significant harvest phase kicks in. ARC's projection suggests that productivity growth could jump from its recent average of roughly 2% to a remarkable 5%. If this is even directionally correct, it fundamentally changes everything. Higher productivity coupled with stable or even falling employment leads to a drop in unit labor costs. Declining unit labor costs mean inflation fades, not due to a collapse in demand, but because of radical improvements in efficiency. This is the Goldilocks scenario for assets like Bitcoin. Not a recession, not a crash, but a quiet structural shift where purchasing power improves and the intrinsic need for hard money becomes increasingly apparent over time. And while this productivity revolution quietly builds momentum, gold is unequivocally signaling a message that Bitcoin investors must heed. Gold has surged past $5,000 per ounce, climbing over 60% in the past year alone. Central banks have consistently purchased over 1,000 tons annually for 3 consecutive years, with the metal nearly doubling from its 2022 lows. Larry Lepard has witnessed this exact scenario before. He anticipates that when the next significant print hits, we will see a similar explosion, with prices potentially soaring from $50,000, $60,000, or $70,000 to $240,000 or $300,000, or some other substantial figure. The central banks are indeed printing a lot this year. They have pivoted, shifting from tightening monetary policy to stopping it. Now, they've introduced what they call a reserve management program, which Larry finds quite amusing, calling it a rebranding of quantitative easing. They claim banks need more reserves, so they are injecting $40 billion per month. Larry asserts that this amount is mathematically destined to grow. It's not an opinion, but a proven fact that they will need to expand the money supply or bank reserves. $40 billion a month amounts to $480 billion annually, which Lynn Alden has dubbed the gradual print, referencing Larry's book. Larry responded to her on social media, emphasizing that gradual can quickly become big, and he believes that's precisely what will happen. He recounted a recent call with a very smart investor who, despite his intelligence, was heavily invested in Bitcoin and growing scared. Larry's advice was simple: relax, man, it's all good. He points out that newer investors haven't experienced previous cycles. For those who don't need the money in 3 months, patience is key. Larry acknowledges that for some, like his wife, it's not just the percentage drawdown that's unsettling, but the sheer dollar amount involved. When Bitcoin hits $350,000 and then drops to $180,000, the perceived loss is a far larger, more daunting number. While it's easier for seasoned investors with lower average cost bases to remain calm, Larry notes that even he bought at $65,000 and some at $100,000, though not at $125,000. The undeniable pattern for Bitcoin is higher highs and higher lows, and this trend is set to continue. In 2020, gold broke out first, running from $1,200 to $2,000 per ounce, while Bitcoin remained range-bound between $5,000 and $9,000 for months. People grumbled, claiming Bitcoin had lost its edge, rotating into gold and traditional equities. Then, the liquidity floodgates opened. The Federal Reserve expanded its balance sheet from $3 trillion to $9 trillion, and Bitcoin subsequently surged from $10,000 to $60,000 in approximately 6 months. Larry sees an identical setup unfolding now. Gold has already made massive moves, sending a clear monetary signal. The need for liquidity is accelerating, and hard assets are repricing accordingly. Bitcoin has not yet responded, but the Fed has already resumed injecting reserves, approximately $40 billion per month, through their reserve management program. Larry's message is straightforward. Gradual can escalate to big very rapidly. And when it does, Bitcoin offers no time for positioning. It moves in days, not months. Missing just the best 20 trading days over a 6-year period would have left an investor flat, even though the asset itself performed 6 times over. So, when we combine these two powerful signals, what do they tell us? On one side, we have a productivity revolution that is tangible, measurable, and accelerating, yet remains largely unseen by those not paying close attention. AI is fundamentally transforming how companies operate, at a pace not witnessed since the advent of the personal computer. This transformation is inherently deflationary. It enhances efficiency, reduces costs, and paves the way for a world where hard money, money that cannot be inflated away, becomes the most logical store of value. On the other side, gold is at all-time highs. Central banks are accumulating it at a record pace, and the monetary system is quietly signaling that more printing is inevitable. Bitcoin lagging gold in this environment is not a sign of weakness. It is the exact same lag we observed in 2020, and every time that lag is resolved, it has done so with violent upward momentum. The Magellan Fund investors missed their tremendous returns because they lacked the patience to stay put. They couldn't endure the confusion. They sold the dip and chased the rip. Do not be that investor. The signals are clear. The evidence is mounting. The only remaining question is whether you possess the patience to act on this insight before the rest of the market catches up. Do you think the productivity revolution changes the inflation story for crypto? Is Bitcoin's lag behind gold a buying signal or a warning? And how do you manage the psychology of holding through a drawdown like this?